Well, we had a healthy pause and a healthy pullback in some of the very crowded momentum trades, which of course tend to be dominated by tech. So we were not surprised to see the pullback. I'm glad it happened because it did clean up some of the positioning. It did clean up a little bit of the extended valuations. And Mike is right. There was nothing about that pullback that we saw last week that was fundamentally driven. So that's why when clients are looking for things that they want to buy, that they have conviction in over the long run, they'll look to some of these big tech names or tech names in general, because their fundamentals are not only not changing, they're being strengthened. And when you looked at some of the big tech names, they were trading down 10% or more from their 52-week highs. So we don't often get those types of opportunities. So I think all that cash that is in the sidelines thinking about how much of the rally it might have missed, I think that cash is finding its way in the markets. And by the way, not just cash into the equity markets, cash equities, but also derivatives. If we look at the option story behind some of the big tech names, the implied volatility for the call options is still very much elevated. As elevated as it is for the put options, that typically does not happen. So that suggests to us that investors are chasing tech, and they're also chasing it in options.
Mike, banks continue to languish. Citi in particular is now down 6.5% or 12% over 2 days. What's driving that? I mean, I know we had some headlines earlier, but amazing how regularly, anytime they start to show some positive momentum, the wind gets taken out of the sails again.
Yeah, the only areas of the market that have started to perform better and got some traction, aside from the big growth stocks, have been cyclical. So it's parts of the market that are very much geared to upside on a continuing economic recovery. And financials, while cheap and certainly very heavy in the value baskets of the market, don't seem to have as much leverage to an improving economy. You have this kind of accumulated losses building up on the credit side. Even if it's not debilitating, it's a drag on their numbers. And then very, very stubbornly low yield. So it seems as if they're once again there's this kind of dynamic that always goes in there. People buy them because they're cheap, because they've underperformed too much, and then nothing much happens with them. There's no buybacks as a backstop. So that to me is the dynamic. But when we do get a yield lift, I think obviously they're very primed for another one of these ripping bounces. I just don't know if it'll come to much.